Good morning, good afternoon, good evening, wherever you are in the world today. Welcome to the Sustainable Investment Forum North America 2020. My name is Ben Caldecott. I'm a professor of sustainable finance at the University of Oxford. It's my great pleasure to be your chair for this virtual session today. Thank you for joining us. I know many of you are joining us from around the world, but particularly, of course, from North America. The Sustainable Investment Forum North America is a four-part series. We are now in the second part. It's good to see you again after 1 week. I hope you've had a good week. The series is organised in partnership between Climate Action and the UNEP, United Nations Environment Programme Finance Initiative. This would normally be in person, but it's transitioned to an online event given circumstances around COVID, as you can imagine. The forum and the four-part series is officially affiliated with Climate Week New York as well, which has been very successful so far. Today we're going to have a special focus on the role of responsible investment and the role of responsible investors in the changing world order that we're seeing, and how responsible investment can contribute to those changes. We're going to talk about the UN Sustainable Development Goals as well, and whether there are relationships with or trade-offs with financial value and seeking financial returns. That's a very active debate. We're going to talk about those issues. And we're going to talk also about assessing risks and opportunities related to climate change, and a number of speakers in a panel that are going to talk about climate-related risks and how they can be integrated into investment decision-making. This is organised by Climate Action. As I said, Climate Action was established in 2007, and they do a range of events on these issues and others. The official event partner is UNEP-FI, and over the past 5 years, UNEP-FI and Climate Action have been collaborating on these forums in North America and in Europe. UNEP-FI has hundreds of different financial institution members. Many of you will know UNEP-FI. They are responsible for creating the UN-backed Principles for Responsible Investment in 2006. In 2012, they established the Principles for Sustainable Insurance. And most recently, in 2019, last year, they established the Principles for Responsible Banking. And throughout these forums, we've been talking about the Principles for Responsible Banking and the impact they've been having. This forms part of a roadmap of different events in the run-up to COP26 that Climate Action are organising. You can find out more details about all the different events they're organising on their website. There'll be many related to finance and sustainable finance. On behalf of the organisers, I want to thank the various sponsors as well as the virtual exhibitors. You can engage with them on the platform throughout the week and over the course of the forum. And you can also meet with and interact with sponsors as well and different partners. On behalf of the organisers, I also want to thank the institutional and media partners. You can see them on the screen. There are lots of them, and many organisations you'll be familiar with, as well as the sponsors too, of course. Now, just some quick housekeeping before we get going. The session is being recorded. That's a good thing because that means you can catch up on the session if you miss anything, and indeed you can catch up and watch the session from last week in case you missed that. So it's all being recorded. It'll be available shortly after the session finishes. I mentioned the virtual platform. You can engage with that online. That gives you access to some new industry research and reports and white papers. It can also enable and facilitate networking, so you can interact with different sponsors and partners, as well as the hundreds, if not thousands, of people that are tuning in to watch this session. And please do take advantage of that during the break. You can also bookmark upcoming sessions. This is every Thursday. Make sure to check out the different things, put them in your diary so you don't miss them. And you can engage with industry leaders every week through the platform. Really important with an online event that you try and participate online. That's one of the disadvantages of doing this remotely, virtually. You can ask questions through the platform. You can ask questions through social media. Just make sure to identify who the question's for. And if you're doing it through the platform, say who you are and where you're from. That would be really helpful to make sure we can get questions to the right people. So we've got two sections to this morning. The first is an interview with Elliot Harris, who is the UN Assistant Secretary General and Chief Economist at the UN Department of Economic and Social Affairs. And that's going to then be followed by a panel discussion looking at the SDGs and responsible investment that's going to be chaired by Dustin Lands, who is the CEO of the Responsible Investment Association Canada. That's going to be a really interesting panel, so you should stay tuned. Now, it's my great pleasure to welcome Elliot to the stage. Elliot, are you there?
Morning, Ben. Thank you very much for having me.
And pleasure. Really glad you could come. So you're Assistant Secretary General for Economic Development. Previously, you were head of the office in New York for the United Nations Environment Programme from 2013 to 2018. And before that, you're at the IMF. So a really impressive track record and CV on all of these questions. Now, one of the things I'd like to ask, and quick reminder to the audience, of course, to do send us through your questions. But the opening question, what are some of the challenges in mobilizing finance for sustainable investments? And are the prospects of that changing, particularly in light of what's going on in the world today?
Thank you for the question. Yes, indeed. I think there are indeed remaining challenges. I see 4 of them. The first one is simply the perception of risk. When we talk about sustainable activities, these are activities that are fundamentally different to what we had before. And that generally means that there are new projects, new technologies involved, and the methodology for assessing risk is somewhat more complex. There's no standard approach. And that heightens the perception of risk and might make it more difficult for investors to engage. The second thing is the question of the pipeline of sustainable projects. There's the perennial problem of what is in fact a sustainable project, who defines that, and how do you measure that degree of sustainability. And in conjunction with that, we have the problem that what we would consider to be sustainable is very often longer term in nature, and that goes against the more established short-term bias of many market participants. There's a third question, which is scale. As we're doing new activities, the initial round of projects in sustainable activities will generally tend to be somewhat smaller, and small-scale projects have greater difficulty in mobilizing institutional capital than larger-scale projects. And when these projects are in smaller economies or in smaller contexts, the situation is compounded. But the fourth challenge, and I think this is perhaps even the biggest one, is that it is still far too easy to make a healthy profit doing unsustainable things. And it's really important not only to mobilize new money for sustainable investment projects, but to shift the existing flow of resources away from unsustainable activity, because that then would mean that the investors are out looking for new investment opportunities that are sustainable. Now, we've seen that improve dramatically over the past 4 or 5 years, and that is response to the second part of the question. Yes, the prospects for achieving this, mobilizing finance, are very good. We've had this massive increase in the interest in ESG investing, and that, I think, is perhaps the most encouraging factor of them all. I think it's become a very clear part of the business case that managing according to environmental, social, and governance factors is good for business. And we see more and more firms collecting the data that they need in order to do this, and more investors focusing on that kind of information in order to make their investment choices. And that is tremendously important because it totally nullifies the sense that investing in sustainable activities is somehow bad for business or generates inferior returns. It does not. We've seen all of the various initiatives within the private financials community, and you mentioned them. The principles of responsible investment, principles of responsible banking, principles of sustainable insurance are just examples. We have a lot of initiatives in the business community as well. I'd like to refer to the Net Zero Asset Owners Alliance, where investors are telling themselves that they're going to shift the composition of their portfolios to be net zero in terms of carbon footprint by 2050. And there are many other initiatives underway that show that the private business and financial community have bought into the concept of sustainability as being part of good business. And there's no reason to expect that this will be in any way changed in future years. It'll be accentuated going forward. Where I see the biggest problem, however, still is this question of making it less profitable to invest unsustainably.
Thank you for that, Elliot. And just you can imagine what the next question is going to be then, which is you set out these 4 barriers, these 4 challenges. When you're thinking about the different levers you have, when you're thinking about fiscal policy, monetary policy, regulatory interventions, all the different things you'll be thinking about UN-DESA, what are the right levers to pull to change the situation, overcome those challenges. And of course, that is a multi-trillion-dollar question. You can pick off one of the challenges first if you want. There's lots to talk about.
Well, I think the simple fact, the unfortunate fact of life is that public policy has not changed to make itself consistent with the commitments that governments have signed on to, for example, under the Paris Agreement. And the reason that has happened is because the political will is lacking, or because not enough effort has gone into making sure that we have the political consensus to move in that direction. And there's a lack of predictability in policy. And so that itself is a major hindrance to mobilizing the resources, mobilizing the investments that we need. Governments have a whole lot of tools at their disposal. Public procurement, for example, can be directed towards goods that are sustainably produced, services that are sustainably produced. Public infrastructure can be made much more sustainable, and we're talking about energy systems, waste management systems, public transportation. Fiscal policies can be adjusted so that they take away any support to unsustainable activities, so for example, eliminating fossil fuel subsidies, and they make more expensive or less attractive the unsustainable activities by, for example, putting a price on carbon or taxing polluting activities. And you can also do differential taxation of things that are more sustainable or less sustainable. And the range of options there is actually quite large. And then, of course, you have regulations, you have efficiency standards, you have limits, you have outright prohibitions. There's much that can be done. But over the last year, I've started to think that perhaps the greatest potential lies in the actions of the financial and monetary authorities. Now, we've seen in the response to COVID that central banks have intervened massively to put liquidity floors under markets, stabilize them, and that's been, by and large, very, very effective. But there's more that they could do. They can continue to support the ongoing trends that we mentioned earlier in private financial markets, the shift towards ESG investing and so on. They can support the measurement systems that are needed to be able to identify what is sustainable, identify the risks, measure them. They can change the definition of fiduciary duty to make it more understandable to investors that considering sustainability factors is in fact a part of their fiduciary duty, and that would be a tremendous boost to institutional investment. We have, of course, the prudential regulations and the supervisory requirements that can be adjusted to remove some of the short-term bias that does actually exist. We do a lot of quantitative easing now. That can be differentiated. Discount rates can be adjusted and differentiated to take into account a particular asset is sustainable or less sustainable. Green credit guidelines, green and social impact bond guidelines, guidelines for pension funds. All of these are issues that central banks, monetary authorities, financial supervisors can deploy to accelerate the transition of the financial system towards a sustainable financial system. And one of the more important things that can be done there is working to create a taxonomy of sustainable activity so that we all have the same understanding of what we think is sustainable, and that we can all move in the same direction to devise ways to measure that.
So lots there, a lot that I agree with. So one counter-argument to the focus on central banks and financial supervisors that you hear from central bankers themselves. They go, look, our job is to not, we can't compensate for poorly designed policy or non-existent policy. It's not our job to create the real economy signals. We can tinker around the edges. Yeah, sure, we can green QE a bit. We can take account of environmental factors in that. We can change prudential regulations. But look, the heavy hitting stuff is government regulation and policy, and they throw it back at the policymakers. So what would you say to that argument? Do you agree with them? Or do
I
you
think they are right.
They're underplaying the amount of stuff that they can do?
I agree with them, and I do think that they are underplaying what they can do. I will say, when I first started engaging in this discussion a few years ago, I was a little skeptical about the role that central banks can play. But the fact of it is, the real economy can only function when finance is there. The central banks are at the heart of finance, and they can influence the way in which finance is deployed, the issues that finance has to take into account. And what we've seen coming out of central banks as well over the past couple of years is this awareness that climate issues are salient, material to financial decisions, that environmental issues affect the ways in which markets function and consequently affect the outturns of financial investments. And so consequently, I think it has to be a part of the overall framework within which monetary policy is conducted, within which financial regulation is framed. And therefore, if that is indeed the case, there seems to be a much larger role that financial regulators and central banks can and should play. Now, if we know that pursuing climate activity, or sort of activities that are not consistent with climate action, are increasing the risks to the financial sector, then prudential regulation should take that into account. And that means that there's a role that central banks or other regulators can play in limiting that amount of activity because it contributes to financial stability going forward. But central banks are also supposed to create the conditions for stable and sustained economic growth with low inflation and job creation. That is part of the mandate of many central banks, if not all of them. And as we talk about the quality of growth that we want to have, it's clear that we've committed we want to have low carbon growth that is resource efficient and that is inclusive. And central banks certainly can be part of the solution to that, part of the effort to create the conditions for that kind of growth. And therefore, I think it's perfectly understandable and actually acceptable that central banks seriously consider what should their role be, or how far could the boundaries of their role be extended when we think about the kind of economic activity that we need to have, the kind of transformation we need to generate so that we can have sustainability going forward. So yes, they do have this question of, should not public policy first set the stage? Yes, it should. But central banks and monetary policy, financial regulation and supervision also have a role to play, and they need to align themselves with that objective.
Yeah, very, very good points. And Elliot, I wanted to pick up on something else you mentioned, which was around a taxonomy. And you were saying that that's important because it helps and enables financial institutions to compare things properly and the sustainability of things and the sustainability of investments. But do you think it's plausible or likely that we're going to have international consensus on what's really green? I mean, we saw this with the EU attempt at the taxonomy, the French saying, look, nuclear should be in, the Poles saying, well, we really like coal, and these tensions at play. And of course, you take that to a global level, it's going to be so much harder. Is it realistic that we would have such an international taxonomy?
I think eventually we will converge towards one. I think we will start off by having a series of different platforms and standards. There will be elements of commonality from one taxonomy, from one system to the other. And as we build on those elements of commonality, we will start to focus our attention more on where are the various differences and why. Now, I think what will help here in having that convergence around the taxonomy is when we make progress on the measurement side, on the metrics. Because if we understand what it is we're trying to measure and what we want to consider as contributing to the sustainability of a particular activity, then we will find that it becomes more objective. The way in which we regard a particular type of activity becomes more objective because we can measure it in a reasonably acceptable way. And that objectivity will allow then the market pressure and the public policy to converge. And so that activities that maybe 4 or 5 market players or segments of the market consider to be unsustainable while one considers to be more sustainable, that difference of opinion will become more evident. And there's always going to be a premium that comes out of having a standard that most, if not all, market participants can adhere to, simply because it makes the use of that information much more convenient and much more powerful. That's one of the reasons why ratings agencies play such an important role in guiding investment, because people understand what is meant by the metric that is used, by the judgment that is brought by the rating agency, and that allows the investment decision to be made in a reasonably consistent way across individual projects, across individual markets. That compelling force, I think, will also drive the convergence around a global taxonomy. It will not be done by one institution, but the various taxonomies will inevitably converge simply because the market will require it.
And what do you think the UN system and indeed governments can do to accelerate that process of convergence and also enable better comparison? So although we might have different taxonomies in different places, certainly in the medium term, the focusing on the data and the metrics to enable comparability is important. I mean, what do you think about how governments can support all of that?
Well, I do think the most important thing here is to focus initially on starting the work on the taxonomy, where that hasn't started yet. And that you need not reinvent the wheel every time, but you can take what others have perhaps initiated, adapt them to your own particular circumstances, and work from there. The second point, I think, is working on the metrics. There are lots of initiatives in the private sector on individual markets that seek to measure specific aspects of how firms behave and what their results look like. And one can build on those metrics, which are becoming increasingly accepted, and use those to start to measure, for example, the degree of exposure, if you will, to climate risk. Now, that is exactly the sort of thing that the Task Force on Climate-Related Financial Disclosure has been doing. When we go down that road, we find that we have to establish metrics that are commonly accepted and that people start to report along those metrics in a consistent and comparable way. And that, I think, is then the foundation for moving towards a better and more broadly accepted measurement system that then becomes the foundation of a reporting system. Reporting and disclosure then become critically important. And that's where governments as well can drive the process, because the more they include such reporting in the overall requirement for financial reporting of firms and of investment actors, the more that becomes a standard part of the overall informational framework. And we've heard some very credible leaders saying that reporting on climate risk, for example, should be made mandatory by the monetary authorities, the supervisory authorities. And once that becomes a mandatory reporting requirement, standardization has to follow, because we can't have 15 or 20 different definitions of what that climate risk is going to be. And these are some of the actions that I think the monetary or the financial authorities can take to drive this question of measurement of risk and make it an essential part of the decision-making framework for private investments.
Absolutely. And we had yesterday I4S announcing a consultation saying, should we enter this space and help to consolidate and standardize a fragmented standard system. So I think that's absolutely going to be an area where there's a lot more work. Elliot, there's never enough time. There are lots of things I wanted to ask you about. Thank you, though, for sharing your expertise and joining us for a period of time. And I hope you tune in for the rest of it. And I hope we get to speak at some point soon. Thank you for joining.
Thank you very much.